Now we will take up on to question number 2. Question number 2 is a typical problem on consolidated financial statement as well as cash flow statement. From the following figures, prepare group cash flow statement of holdings. They are given you as on 31st of December 2010, the balance sheet of both holding and subsidiary company, and once again by 31st of December they just provided the information. On 1st of January 2011, holding acquired 80% of the share capital of subsidiary from certain shareholders at a price of rupees 5 lakhs by issuing its own shares at the rate of rupees 200 per share. No entries have been made in the books for this. Holding company acquired certain items of equipment from subsidiary, which is dealing this item in December 11 at a price of rupees 10,000, profit rupees 2,000. No depreciation has been charged on this asset for the year. During the year, subsidiary company declared and paid a dividend of 20% in June 2010 in respect of year 2010. Holding Limited credited dividend received to profit and loss account. Holding Limited also paid a dividend of 10% in respect of 10 in the year 11. Show all workings clearly. Subsidiary depreciation charge during the year holding 70,000, subsidiary 25,000. Problem in there. So now let us just find out as how we can proceed. So firstly, there is a problem on consolidated financial statement. Now let us just proceed on to that. Consolidation wherein acquisition was made on the very first day, 1/1/11. So general reserve, what you have, say one moment. General reserve for a subsidiary company starting at the beginning at 60,000 rupees, whereas the same is appearing at 80,000 rupees. That means increase took place during the period to the extent of 20,000 is a post-acquisition occurrence. So classification starts at this moment, capital and revenue. Now let us have a look at profit and loss account. Here is a place where you got to be very careful that profit and loss account as existed at the year beginning was not the intact again. And for the year 2010, dividend was paid in the year 2011, and for that you would have pulled out from such opening balance for the purpose of dividend some amount. So there will be some reduction in the opening balance to the extent of dividend declared during the current period for the last year. This is for the last year, dividend is paid during the current period. So we understand that 40,000 rupees you would have paid from the opening balance of 90, and out of the opening balance we have only the extent of 50,000. Therefore, remaining 80,000 is the current year's profit. Current year's profit is revenue. And then there was a transaction happened at the end of the period to the extent of rupees 2,000. That is profit on transfer of machinery, and the profit was generated by subsidiary company. Transfer was made by subsidiary company. It is an upward upstream sales, and profit is generated by the subsidiary company. Will get distributed between parent and minority interest in the ratio of 80/20, and that is what you just find it is appearing there. Now, as we normally do the chart A, chart B basis, we understand that the capital profit will be distributed between parent and subsidiary in the ratio of 80/20. General reserve 60,000, profit and loss account 50, total lakh and 10,000. That will get distributed in the ratio of 80/20, 88,000 and 22,000. General reserve, as you have seen, there was an increase in the general reserve during this post-acquisition period of 20,000, 80 and 20 had just gone between parent and minority interest. Profit and loss account, as you have seen, there was an increase to the extent of 80,000, and this 80,000 was worked out as a difference between 1,30,000 and 40,000 rupees. Not 40, 50,000 rupees. That change you have seen 90,000 minus 40,000. 64,000 will go to parent and 16,000 to minority interest. Equity share capital 2 lakhs. So there was an increase in capital only in parent company for the amount of purchase consideration they pay, and not in the share capital of the subsidiary company. So that will continue to be the same. And the minority interest share in the profit on transfer of machinery is to be deducted, and minority interest is 81,600. So dividend of 2010 paid in year 2011. So where we have just developed these columns. Holding company had a equity capital of the last year to the extent of 5 lakhs, and whatever share capital that they have issued for purchasing the 80% of the net asset of the subsidiary company had happened only in the year 2011. So therefore, the dividend which was paid was based on the capital that existed in the last year. So therefore, shares issued during the current period and the dividend of the last period are not at all connected. So therefore, we don't have to just worry. The rate of dividend is 10%, being 10 and 50,000, and no portion of that dividend was received by that particular company. That is by that company and only by the shareholders who are real outsiders, and received by others, I mean the shareholders. Whereas subsidiary companies dividend amount being 40,000, in this 80% is belonging to parent company and only 8,000 had gone out of the group. So the dividend paid by the group as a whole will be 58,000, all related to the last year paid during the current period. And this 32,000 rupees was stated as credited to profit and loss account by mistake, that we have got to rectify. So now goodwill or capital reserve. We need to find out the goodwill both at the beginning, at the time of acquisition, as well as the time of consolidation. Investment 5 lakh, less pre-acquisition dividend 32,000. So this amount we have deducted only for the year end, because, and we have not deducted at the year beginning because the amount of dividend was received only during the current period and not at the beginning. In any case, the goodwill will be the same. So nominal value 1,60,000, and the amount of capital profit had you prepared on the date of acquisition would be 60,000 general reserve. That point of time, profit and loss account would have had only 90,000. So the amount of deduction from profit and loss account had happened only during the current period, and therefore the entire 90,000 would be there. Capital profit for the opening is different from that of capital profit for the closing. And in any case, you just find we end up with the same amount of goodwill, that being 2,20,000. Chart C, consolidated reserves and surplus, and parents holding, there is parents general reserves 1,60,000, share from yes 16,000, total figure 176. Profit and loss account similarly, parent 1,80,000, add share from subsidiary company 64. Then we got to deduct towards stock reserve on transfer on machinery, and pre-acquisition dividend wrongly credited to be rectified, and the final figure is 2,10,400. And the next one is consolidated balance sheet. If you have a patient look at these figures, you just find that they're all agreeing in full, and our focus now is getting shifted to consolidated cash flow statement and not on financial statement, I mean balance sheet. Look into your minority interest from 70,000 to 81,600. That 11,600 increase is only through profit and loss account, and that is the way we have just taken up. Even it might have accounted on account of general reserve also, but general reserve also routed through profit and loss account. So as we normally do for statement of changes in working capital, the same thing we have done, opening and closing. The difference increases on account of stock. Stock increase should be considered as an outflow. Debtors increase outflow, and bills receivable increase outflow. Bills payable increase inflow. Creditors increase inflow, and fixed assets on which some adjustments we do have, closing balance, and this is after deducting towards that unrealized profit, and we have to add back so as to find out the real increase that took place. Depreciation 95,000. This is a figure before deducting towards depreciation. Opening balance from which if you deduct, that is opening balance when you deduct from the closing, what you get is increase, that is equal to purchases. Cash flow from operating activities, increase in profit and loss account. That's how we have got 2,10,400 at the end, minus 1,40,000 rupees at the beginning, and from there we are deducting 58,000 rupees. This 58,000 is on account of dividend paid for the last year, paid by the group as a whole. So this is the real increase that took place. Increase in general reserve that got transferred from your transfer from profit and loss account, 76,000 rupees. So this on account of parent transferring it to general reserve, subsidiary also transferring it to general reserve related to parent's interest. Minority interest share increase 11,600. As we are just giving the explanation as how the changes were taken care. Profit on transfer, depreciation 95,000, and total comes to 3,13,000. Cash flow from operating activity, changes in debtors, bills receivable, bills payable, and creditors. All put together, it comes to 2,28,000. Cash flow from investing activities, purchases and cash flow from financing activities. All that changes, if you look at it, comes to 75,000 rupees net increase. Opening balance 85, closing balance 1,60,000. With that, this solution comes to an end. So students, please take care of this cash flow statement. It is quite an easy one only. If you closely observe all these matters, it would be very easy for you to catch up. Okay, all the very best. I will just see before the end of the examination with some more problems, as the students are asking lots of doubts. This is the only channel through which I can communicate to you. So please keep your doubts posted, and at the earliest point of time I will just reach you through YouTube and through our website sriramcoachingpoint.com. Thank you. Happy Diwali.